Hello, this is Todd Bailey from Fortress Risk Management, and I've been asked to talk about captive insurance for the 10-minute call this week. Captive insurance is a heck of a tool. I've been working with captive insurance for almost 15 years. Prior to that, I spent a couple of decades as a tax lawyer and then migrated into captive insurance because it is such an awesome tool to have in your toolkit. Now, first, what is captive insurance? Captive insurance itself is a semi-private insurance. And I say semi-private because our clients can create a captive insurance company and then participate in a risk-sharing pool. The risk-sharing pool helps to satisfy insurance requirements so that we get the tax treatment and the risk management that we're after. The captives aren't new. The captive structure itself, gosh, that's a century old. The tax treatment we use is also not new. We're not relying on some new esoteric private letter ruling or rev rule or such. We have something from the Internal Revenue Code. Back in 1986, Congress added Internal Revenue Code Section 831B. When they added that, it opened the door for small insurance companies to be created and to grow. Congress likes insurance. Congress gives insurance companies really favorable tax treatments. Now, there's a reason why Warren Buffett owns a bunch of insurance companies through Berkshire Hathaway. He's kind of funny. Warren will talk publicly about how we rich guys need to pay our fair share. We should pay more tax. And yet, through his business, he buys a lot of insurance companies like Geico. And there's a reason for that. He's not simply buying Geico because he enjoys insuring automobiles. He bought Geico because Geico is an insurance company. And as an insurance company, it gets some terrific tax benefits. In particular, it gets to defer the payment of tax on its income, often for half a decade. So the deferral is powerful. It's a great way to mitigate taxes and manage that tax burden. With captive insurance, we go further. We can do something even Warren Buffett can't do. With captive insurance and with Code Section 831B, we get insurance profits that are simply not taxed. They're absolutely tax-free. And that's by design of Congress. Congress wants insurance companies to be able to grow their investment reserves to back the insurance company's obligations. And that's why we get this special tax treatment under captives. Now, to put a captive insurance company together, the first thing we do is we consider potential coverages for a client. And for that, we want to look at the risks that the client has in his or her business. And we want to figure out what can be covered by commercial insurance policies. We want to keep those in place. And then we'll consider other risks that we can cover through the captive. And we're looking for things that are not covered by commercial insurance. And there's no shortage of things that we can cover. Typically, we'll find 10 to 12 coverages for a business when we're looking at captive coverages. And we've gone as high as 18 or 19 coverages for a business. It just depends on the risks of the business. And the risks we're looking at are pretty unique. We're going to get into things like regulatory investigation, loss of a key customer, crime and employee dishonesty, things that are just simply not covered or they're excluded from commercial insurance coverages. And I've got a good example of this. We work with a large physical therapy clinic, multiple locations, a couple dozen locations. They have all of the standard commercial policies in place. In their general liability policy, they cover all sorts of behaviors of their therapists and employees. But, and this is very typical, the coverages exclude sex discrimination. And that's common. You're not typically going to see sex discrimination, sexual harassment, things like that covered through commercial insurance. They're going to exclude that kind of coverage. It's just a little too hot, a little too difficult. However, with captive, we can choose to cover that. For this client, we went through their general liability policies. We saw that exclusion and we were able to provide coverage. And that coverage came in pretty darn handy just a few years later. One of the clinics had a physical therapist that needed to take pregnancy leave. She was about 7 months along, and They needed to get some coverage while she took some pregnancy leave for a few months. They carefully advertised to find candidates that were qualified and could provide coverage for this pregnancy leave. They started interviewing candidates, and one of the candidates that showed up had the licensing, great experience, good reputation, but she was also about 7 months pregnant. So that wasn't going to work for the pregnancy coverage. They declined hiring her, and about 10 days later got hit with a sex discrimination lawsuit for refusing to hire a pregnant woman. Well, that was just a bogus claim, kind of set up our client for that, and then hit the client with a claim. Fortunately, we had coverage for that. Now, this is kind of interesting. The client could have simply litigated without coverage, and I'm confident the client would have won the case because it was just a bogus, frivolous claim. However, when you're a physical therapist, you don't want sex anything showing up in the newspaper headlines. That would be disastrous. It would certainly tarnish the reputation. The impact on the clinics could have been devastating, could have been north of 7 figures. Instead, with the captive coverage, we were able to quietly take care of the problem, work out a settlement, and make this bogus claim go away. For the client, well, that was a game changer. We saved a heck of a loss for the business. So that's one place or one way that captive insurance really shines. We're covering things that can't be covered elsewhere. For the client, there are some real perks. Besides the coverage, we have the tax incentive from Congress. If we run the captive, we expect to have some profit at the end of each insurance policy year, and that profit will have typically some tax involved. So even with Geico, there's going to be a day of reckoning. But with captive insurance, there's no day of reckoning. We'll still figure out the profit. We're still going to book it as profit in the accounting records, but the tax on that insurance profit is truly zero. There is no tax at all on the insurance profit. That allows our clients to build up a nice secondary profit center for the business. Captive insurance will operate as a standalone corporation doing its insurance thing, and it will allow our clients to accumulate a good deal of wealth for managing the risks of the business, also for other things. We just finished working with the underwriting and actuarial work for a dentist in California. For her practice, we went through the underwriting, gathered the facts, worked with our insurance actuaries. We identified the coverages that were appropriate, and then the actuaries determined how much premium would be appropriate for each policy. Her coverages, and I'm going to round just a little bit, her coverages, I think she had about 12. They had a premium of $150,000. She's in the state of California. She's in the 50% tax bracket. If she doesn't pay the captive insurance premium, that $150,000 will stay in her practice and be taxed at a 50% tax rate, so she'll lose about $75,000 of it. If she pays the $150,000 as a captive insurance premium, she gets to deduct the $150,000 from her taxable income. So awesome tax mitigation. The $150,000 will flow into the captive and provide a variety of coverages for her practice. Based on our historical costs, I can tell you at the end of the third year, we project that she'll have about $425,000 in her captive insurance investment account. If she simply pays the tax and invests the difference, doesn't use the captive, takes the full tax hit, she'll have about $240,000 in hand at the end of 3 years. So 240 versus 425. $425,000 is kind of interesting. That's money in her captive. She's investing this with her advisors. The return flows back to the captive. And that $425,000 at the end of the third year can simply continue to build up, which is fabulous. But she can also use that for a variety of planning needs. For instance, she could start taking dividends each year. Let's say she took $150,000 dividend. She'd pay long-term capital gains on the dividend, which is actually kind of awesome because it's going to be far less than her normal ordinary bracket. And then she can use that money to invest in life insurance to solve an estate planning problem, or to fund a buy-sell situation, or even to expand her practice. That extra cash is fantastic. A captive insurance is phenomenal. It's a tool you ought to be adding to your portfolio of solutions to help your clients diversify their tax strategies. We also want to help them mitigate risk, save tax, and then do the secondary planning that comes out of that accumulation, whether it's investing or buying another practice or buying life insurance. It's just a heck of a tool to create that accumulation and to use that for other planning needs. So if you haven't added it to your portfolio of solutions, you ought to consider it. It is a powerful tool, a great door opener, and it could very well save your client's business. So take a look at it. And if you're interested, reach out to Jim, to Rick at Camus, and they can guide you through the process.